The first truth you must face is uncomfortable, even painful. Every trader who enters too early loses. Not sometimes, not occasionally, not a few times a month. Every single time. The market has no sympathy for impulsive action, and pretending otherwise will drain your account faster than any textbook could explain. Most beginners don't see this. They chase charts, chasing the illusion of opportunity, mistaking movement for momentum, and end up paying the ultimate tuition fee: lost capital, bruised confidence, and the nagging belief that the market is rigged. But professionals, real traders like Jesse Livermore, understand a stark difference. The market doesn't owe you a trade. Patience, timing, and selective engagement are the pillars of trading longevity. Livermore's genius was in knowing when to act, and more importantly, when not to. The hidden rule that separates amateurs from pros, the subtle but lethal edge that few ever internalize, is what he called the 5-minute check. Picture the scenario vividly. It's 9:35 a.m., and the tape suddenly begins to show a strong upward move. Your instincts, honed by countless hours watching charts, but not yet tempered by discipline, scream, "Buy now. Don't wait." Your heart races, palms sweat, and your mind begins constructing a justification. The stock is breaking out. Momentum is building. If I hesitate, I'll miss the move. This is the exact moment where amateurs fall into the trap. They buy first, think later, and often exit quickly in panic at the first minor retracement, wondering why they couldn't have captured the full move. Professionals, on the other hand, do something radically counterintuitive. They wait. Livermore wouldn't have bought at that very instant. Instead, he'd pause for 5 minutes, giving the market a small window to confirm its intentions. That 5-minute pause might seem trivial, almost insignificant, but its power is deceptive. Within this small interval, the market either validates the breakout or betrays it. A true move will maintain momentum, absorb minor selling pressure, and demonstrate the conviction of those actually participating. A false move will fizzle, leaving impulsive traders holding positions against gravity. This tiny window, seemingly innocuous, acts as a filter against the most common account killers. Early entries that feel right, but are actually traps. Doing nothing in this sense is sometimes the most profitable trade you'll make all day. Each false entry avoided is not merely a victory of discipline, it's tangible capital saved. Imagine losing $1,000 per $10,000 position due to premature entry. Over months, over dozens of trades, the arithmetic is sobering. Hundreds, if not thousands of dollars preserved simply because you paused, waited, and observed. Paradoxically, the act of waiting amplifies your professionalism. Impatience is the hallmark of the amateur. Verification, the mark of the seasoned trader. By allowing 5 minutes to pass before acting, you give yourself time to test the tape, to observe conviction, and to avoid the ubiquitous fake breakout that destroys nearly 70% of novice traders within their first month. Think about that. 7 out of 10 people entering early will end the month underwater, not because they lack skill in reading charts, but because they lack the discipline to wait, to let the market speak before committing capital. The 5-minute check is not a sign of indecision. It is structured, deliberate discipline, a framework for separating luck from strategy, impulse from edge. Let me give you a concrete mental picture. The tape shows a stock surging. At 9:36, there's a minor pullback. At 9:37, volume spikes slightly, but not enough to confirm. At 9:38, the stock retests its high, but bids are weak. A novice trader sees green and buys, ignoring these subtle cues, assuming the breakout is solid. Livermore, however, watches silently. He notes the pullback, the weak bids, the uneven volume. He's not missing the trade. He's filtering out the trades that are false. By 9:40, the move either strengthens decisively or collapses. His patience ensures that if he enters, the odds are in his favor. The 5-minute check becomes a gatekeeper, a safeguard against the false signals that seduce amateurs into repeated losses. Every time you implement this pause, you reinforce a powerful psychological habit: restraint. Trading is not about acting on every signal. It is about selectively choosing the moments that statistically favor your success. The market offers countless opportunities, but capital is finite. Every early entry you avoid is like receiving a bonus. The market has given you the chance to remain solvent, to stay in the game, to learn without financial penalty. Consider this. Avoiding one false entry per week might seem minor, but over a year, that's potentially 50 instances of preserved capital, compounded confidence, and uninterrupted progress. Discipline, in this context, translates directly into profitability. It's also important to note the emotional mechanics behind this rule. Most traders confuse inaction with missed opportunity. They see the 5 minutes as wasted, as a gap in profit. In reality, it is precisely the opposite. The market will always offer another trade, another opportunity, another chance to profit. But a false entry costs more than just money. It costs composure, confidence, and conviction. The 5-minute check is a method to protect these intangible assets. It teaches you to observe, measure, and respond, rather than react blindly to initial movement. Let's reinforce this with another example. Imagine a stock that gaps up at open. The first instinct is to ride it immediately. Amateurs pile in, expecting continuation. The tape fluctuates, volume is uneven, and by 9:42, the stock reverses, leaving impulsive traders trapped. Professionals using the 5-minute check may have entered later, smaller, or not at all. By adhering to this disciplined pause, they avoid what could have been a painful loss. The market does not reward speed. It rewards patience and alignment with evidence. This principle also underscores the broader identity contrast between amateurs and professionals. Amateurs seek instant gratification. Professionals understand that trading is a marathon of repeated decisions, each weighted by discipline, each informed by observation. The 5-minute check embodies this philosophy: a small pause, a structured moment of evaluation, a filter that separates reaction from reason. Every decision made through this lens reinforces a professional mindset and builds cumulative advantage over time. Notice the nested loops forming here. The initial pain of waiting is offset by the reward of avoided losses. The emotional friction, the discomfort of inaction, is temporary, while the financial and psychological gains compound indefinitely. This is a key lesson in trading psychology. Short-term discomfort often precedes long-term gain. Professionals embrace this friction. Amateurs flee from it. By embedding this single habit, you create a ripple effect across your trading practice. Every entry becomes a deliberate, measured action. Every trade is subjected to scrutiny. Does it pass the test of timing? Does it align with evidence? Does it respect my capital? Livermore's journals repeatedly emphasize this notion. Patience is not passive. It is active. It is the engine of probability, the lever that turns small edges into sustainable profits. As this chapter concludes, keep this in mind. The 5-minute check is deceptively simple, yet brutally effective. It is a foundation upon which all subsequent rules rest. By mastering it, you create the environment for disciplined execution, where impulsive decisions are filtered, losses minimized, and gains more likely. The next section will reveal the mechanics of implementation, 3 specific confirmation methods that allow you to act with confidence after the pause. One of these methods, in particular, will challenge everything you thought you knew about entry timing, offering a perspective that even seasoned traders often overlook. The 5-minute check is not just a rule, it is a philosophy. It trains the mind, conditions the trader, and reshapes behavior. It teaches that the market's language is subtle, its cues fragile, and its movements sometimes deceptive. By waiting, observing, and filtering, you step out of the reactive cycle and enter a domain of strategic patience. Every professional trader understands this principle intuitively. Every amateur ignores it to their peril. In this first lesson, you've glimpsed the truth that separates winners from losers. Patience is not a luxury. It is the currency of survival. In the next segment, we will break this pause into actionable steps, with concrete signals and protocols designed to maximize your edge. Until then, remember, every false entry avoided is not missed opportunity. It is preserved capital, reinforced discipline, and a step closer to trading like a professional. Once you've mastered waiting, the natural question becomes, what exactly do you watch during those 5 minutes? Waiting for the market to speak is one thing. Interpreting its language is another. Jesse Livermore didn't enter trades randomly, nor did he rely on gut instinct alone. His genius lay in identifying precise signals that filtered out noise and confirmed real opportunity. The 5-minute pause only works if paired with active observation, if it's treated as a waiting room where you analyze, measure, and decide based on tangible evidence. Livermore had 3 such confirmation signals, each a small but crucial test of market intent. Understanding them is essential. If you want to trade like a professional, the first confirmation signal is volume alignment. This is deceptively simple, yet often misunderstood. A breakout without sufficient volume is like a car engine revving but not moving. The sound is impressive, but there's no real motion behind it. Picture this. A stock jumps 3% within 5 minutes. At first glance, it looks like a strong move. But when you check the volume, you see it's only 20% of the stock's normal trading volume. An amateur sees green, gets excited, and jumps in, assuming momentum is real. The result? A likely reversal, trapped capital, and psychological damage. The professional, however, sees a weak signal, a move lacking conviction. Real breakouts are accompanied by increasing volume, demonstrating that more participants are committing money, not just testing the market. Volume alignment is your first litmus test, separating flashes of liquidity from genuine intent. Second, Livermore paid close attention to tape behavior. This is subtler, requiring focus, patience, and the ability to read the rhythm of orders. Are buyers absorbing selling, pressure, or is the tape revealing hesitation? A stock that hovers near its highs, while consistent bids absorb selling pressure, indicates a true breakout. Anything else, a flurry of orders in one direction followed by sudden retreats, is noise, tempting amateurs to act prematurely. Tape reading is about observing the market's internal struggle. It's about noticing whether the supply of sellers is being digested by buyers, or if the initial enthusiasm is artificial. Livermore could watch the tape and detect the difference between a genuine momentum surge and a fleeting spike designed to entice impulsive traders. In modern terms, think of it as reading the order flow and commitment behind price movements. Professionals react to evidence. Amateurs react to perception. The third confirmation signal involves pivotal points. These are previous highs and lows that serve as psychological anchors for market participants. A stock testing a prior pivot is making a statement. It's attempting to overcome resistance or support. Amateurs jump the gun, entering before the test is complete. Professionals wait for a decisive breach. Consider this. A stock approaches a prior high at 9:38 a.m. The tape shows tension bids and asks jostling. By 9:40 a.m., if the stock surpasses that pivot with volume and tape confirmation, the probability of continuation increases. Livermore used this as a structural check, ensuring that moves were validated by the market itself, not merely by fleeting sentiment. Pivotal points are not merely price levels, they are checkpoints of market psychology, testing whether enthusiasm is sustainable. Here's a concrete illustration from Livermore's experience. In 1907, he monitored a railroad stock during a volatile session. The tape teased him with small upward blips, tempting early entry. An amateur would have jumped in immediately. Lured by the apparent momentum, Livermore waited. 5 minutes passed, and the signals aligned. Volume spiked, bids held, and the stock decisively tested and surpassed its pivot point. By mid-morning, the stock soared $15 in a single day, and the traders who acted prematurely were left frustrated or trapped. That single 5-minute pause, combined with meticulous observation of the three confirmations, turned what could have been a minor gain or even a loss into a significant low-risk win. It's a textbook example of structured patience outperforming impulsive action. The protocol is clear. The 5-minute check is not passive. You actively observe each signal. Every P side, volume alignment, tape behavior, and pivotal points are your checklist. If one or more fails, you walk away. If all three align, your entry carries a statistically higher probability of success. This approach transforms trading from a guessing game into a disciplined, rules-based craft. It's not merely about being patient. It's about filtering the market through tangible, observable evidence. Waiting without observation is idle. Waiting with methodical checks is strategic. Maxim, check 5, confirm 3, act once. This is more than a catchy phrase, it's a practical philosophy. Every early entry avoided is a mini victory, a saved loss, and a reinforcement of professional identity. Yet here's a twist. Even when all three signals align, Livermore sometimes did nothing. This is the ultimate test of discretion and humility. Opportunity is abundant, but capital is finite. Even with perfect confirmation, circumstances, broader context, or subtle tape cues could override action. The lesson: discretionary discipline is the last line of defense against impulsive mistakes. Professionals accept that sometimes the best trade is no trade at all. To internalize this principle, think in terms of probabilities, not certainties. Amateurs chase what-ifs, professionals trade what-is. Each confirmation signal increases the odds, but none guarantees success. Volume alignment provides evidence of commitment, tape behavior demonstrates absorption of risk, and pivotal points validate market psychology. Together they create a high probability framework, yet the final decision still rests on the trader's judgment. Waiting 5 minutes is about creating space for evidence to emerge, and for the trader to act rationally rather than emotionally. Consider the psychological dimension. Waiting is challenging. Fear of missing out, impatience, and greed all pressure you to act before confirmations fully materialize. By structuring the observation period around the three signals, you give your mind a framework, a defensible reason to remain disciplined. The mind craves action, but structured patience transforms waiting into an active skill. You are not hesitating. You are verifying. You are not missing opportunity. You are reducing risk. Nested loops appear here as well. The initial discomfort of inaction is offset by the reward of evidence-based trading. Early entries avoided, potential losses prevented, and confidence reinforced all flow from adherence to these three confirmation signals. Professionals understand that the market will always offer another trade, another chance, another movement. Amateurs, blinded by short-term emotion, misinterpret the pause as lost opportunity. Learning to trust the process, volume, tape, pivot, is essential to cultivating long-term trading success. Let's illustrate another scenario. A stock gaps up, approaching a prior pivot. Volume is moderate, tape shows hesitation, and bids fluctuate. An amateur trader sees green candles and assumes momentum. They enter, only to be shaken out by a minor retracement. A professional trader, using the three confirmations, sees the hesitation, interprets the signals correctly, and may delay or forego entry entirely. When the signals realign, volume surges, tape strengthens, pivot is convincingly breached. The professional steps in with higher probability and lower risk. This demonstrates the compounding power of methodical confirmation over impulsive action. These three confirmation signals, volume, tape, and pivotal points, form the backbone of Livermore's disciplined approach. They teach that trading is less about prediction and more about response. The market communicates constantly. The trader's task is to listen, verify, and then act. Impulsive reactions are penalized, Measured, evidence-based responses are rewarded. Professionals internalize this pattern. Amateurs ignore it to their detriment. By the end of this chapter, the protocol is clear. Observe for 5 minutes. Confirm with 3 signals. Act deliberately. Even with all signals aligned, exercise discretion. The lesson is twofold. Structure your patience and respect the market's language. This is the bridge to the next lesson, where we explore the psychology of waiting, why even confirmed trades can tempt you into error, and how fear and greed test every trader's discipline. The 3 confirmations are your guide. Your psychology determines whether you execute or falter. Master both, and you step decisively into professional territory. Waiting is easy to talk about, almost a cliché in trading literature, yet impossible to practice consistently. Even after 5 minutes of observation, after confirming volume alignment, tape behavior, and pivotal points, your emotions scream, "Buy now, don't miss it." That moment of tension, the silent pressure of opportunity, is where most amateurs fail. Professionals understand that trading is not just a technical exercise, it is a psychological battlefield. Fear and greed are not peripheral concerns. They are the central forces that determine whether you survive or fail. Controlling these emotions is not optional. It is the core of professional discipline. The market rewards evidence-based action, not impulsive reaction. And waiting structured, purposeful waiting, is the skill that separates those who endure from those who repeatedly blow accounts. Imagine the scenario vividly. You watch a stock testing a pivotal point. The indicators align perfectly. Volume surges, bids absorb selling pressure, and the price convincingly approaches the previous high. All the mechanical signals say, "Go," yet your chest tightens, your pulse quickens, and your mind floods with justifications. If I don't enter now, I'll miss the move. The breakout is real. I can feel it. Amateurs panic in this moment, often stepping in before the decisive candle forms. Professionals, however, breathe deeply, recognize the emotional tug, and maintain their waiting posture until the market confirms. That tiny delay, often just seconds to a few minutes, can mean the difference between a modest $500 winner and a $2,000 loss, or worse, a margin call. The pause is not hesitation. It is the conscious application of strategic restraint, transforming nervous energy into measured observation. Livermore's journals are rich with reflections on this psychological struggle. He consistently emphasized that the hardest trade is the one you feel compelled to make. Waiting forces introspection. Are you trading the market, or are you trading your emotions? Are you acting on evidence, or are you succumbing to the illusion of opportunity? Every impulsive entry erodes not only capital but also confidence. The professional's challenge is to convert this pressure into disciplined patience, to recognize that discomfort is the price of survival. Doing nothing counterintuitively is often the most profitable trade. Every tick you skip is not wasted. It is insurance against unnecessary losses. Professionals internalize this paradox. The market will always present another opportunity, but your account cannot afford the mistakes that come from acting prematurely. To operationalize this, Livermore implicitly created a mental checklist, a structured decision-making framework that governs action under pressure. Before each trade, ask yourself, is volume sufficient to support the move? Is the tape committed, showing that buyers are absorbing selling pressure? Has the pivotal point been convincingly breached? Are my emotions controlled? Or is fear and greed clouding judgment? Only if each box is checked should you execute the trade. This checklist transforms waiting from passive endurance into active skill. Each pause becomes deliberate, each second of observation a calculated exercise in probability management. The market becomes less of a chaotic battlefield and more of a structured arena where decisions are measured, rational, and aligned with evidence. Consider the psychological dynamics at play. Fear of missing out is a powerful force, often stronger than the logical evaluation of market conditions. Greed compounds it. whispering that every tick not captured is money left on the table. Amateurs treat waiting as risk, worrying that hesitation equals opportunity lost. Professionals, in contrast, treat waiting as leverage. The ability to delay action until the market proves itself is one of the most potent edges in trading. Patience is not a passive state. It is active, strategic, and deliberate. Every professional knows that the price of entering too soon can far exceed the perceived cost of waiting. Pattern interrupts reinforce this lesson. Doing nothing, for long stretches, cultivates discipline. It forces the mind to detach from emotion and focus on process. Every moment you refrain from acting, even as the tape teases and volume builds, is a reinforcement of professional identity. Professionals are not rewarded for constant action. They are rewarded for correct, high-probability action executed under calm, deliberate conditions. The 5-minute check becomes a stage for this transformation, from impulsive observer to disciplined actor. Let's make this concrete with an example. A stock approaches a prior pivot, all signals aligned. Volume spikes moderately. Tape shows absorption. Price hovers near the breakout. An amateur sees green candles and enters immediately, driven by fear of missing the move. The stock then pulls back slightly, triggering stops and panic exits. The professional, following the checklist, observes the hesitation. Waiting allows confirmation. The tape strengthens, volume rises further, and the stock convincingly breaches the pivot. When the professional finally enters, the risk is lower, probability higher, and stress minimal. The lesson: structured waiting filters out impulsive, costly trades and converts observation into tactical advantage. Nested psychological loops emerge here. The discomfort of waiting the urge to act is temporary, while the benefit of disciplined patience compounds over time. Each avoided mistake strengthens confidence, sharpens judgment, and reinforces professional identity. Amateurs misinterpret waiting as opportunity lost. Professionals understand it as risk avoided. The mental battle is continuous. Every trade tests patience. Every signal tempts action. Mastery comes not from eliminating temptation, but from training the mind to respect it. Consider another layer. Even when all confirmations align, discretion still matters. The market is probabilistic, not deterministic. Volume, tape, and pivot points improve odds but do not guarantee success. Professionals evaluate context, sector behavior, and broader market dynamics. Sometimes, even with all signals perfect, a trade is skipped. This is not hesitation, it is strategic selectivity, a reinforcement of the principle that capital is finite, patience is leverage, and survival is paramount. Livermore repeatedly noted that the right trade executed at the right time, with the right size and conditions, far outweighs the quantity of trades executed in haste. The mental checklist, when internalized, becomes automatic. Traders begin to self-regulate, recognizing emotional impulses and applying structural filters. Each confirmation, signal volume, tape, pivot interacts with emotional control to produce disciplined execution. Waiting transforms from a passive obligation into an active skill, enhancing both decision quality and psychological resilience. Professionals learn that inaction is rarely wasted. It is preparation, alignment, and edge. Psychology also intersects with risk management here. Even the best trade, if sized incorrectly, can fail. Professionals understand that position sizing magnifies both success and error. Waiting without proper sizing still carries hidden risk. The mental discipline of the 5-minute check lays the foundation for the next critical layer, integrating timing with calculated risk. By mastering patience, you set the stage for executing trades in a way that maximizes gain while containing loss. Impulsive traders skip this step and magnify errors, while professionals treat each entry as a carefully calibrated decision. Maxim: patience is your leverage. Impulsiveness is your debt. This is not rhetorical, it is practical. Every tick skipped, every second of observation, every delay aligned with evidence compounds into professional advantage. Impulsiveness, in contrast, amplifies risk and erodes confidence, often irreversibly. The discipline of waiting, structured around confirmations and self-control, turns what feels like delay into strategic opportunity. Nested loops continue. Observation, evidence, emotional control, and structural patience converge into a single process. Each trade becomes a measured experiment, each pause a strategic maneuver. Professionals understand that the market will always offer subsequent opportunities. Accounts, however, cannot recover from repeated impulsive mistakes. Patience, therefore, is both survival and competitive advantage. By mastering waiting, you set the stage for advanced execution strategies. Position sizing, risk management, and eventual pyramiding all depend on the foundation laid by disciplined patience. The market's signals only become actionable when you are psychologically prepared to respect them, interpret them correctly, and act without succumbing to fear or greed. Waiting is more than a tactic. It is a skill that shapes every decision, enforces consistency, and ensures that even the best confirmed trade can be executed safely. Structured waiting also cultivates reflection. Each paused moment allows evaluation of prior trades, assessment of current market conditions, and rehearsal of protocols. Professionals treat waiting as part of the process, integrating past lessons and present signals into a cohesive mental model. Amateurs, in contrast, treat waiting as a threat to opportunity, and their impulsive actions often repeat historical mistakes. The mental edge, therefore, is inseparable from patience. Finally, the discipline of waiting emphasizes process over outcome. Traders focused solely on profit are vulnerable to emotional overreach. Those focused on process develop resilience. The 5-minute check, when paired with confirmation signals, is a structured method of enforcing this process. Professionals act when the evidence is sufficient and the mind is aligned. Amateurs act whenever emotion dictates. Mastery comes from internalizing both the skill of waiting and the psychological edge it provides, setting the stage for controlled risk-taking and strategic position sizing in the next phase of trading development. Even the most perfectly confirmed trade can destroy a trader's account if the position is sized incorrectly. Jesse Livermore understood this intuitively. He knew that a perfect setup could turn catastrophic simply because the trader committed too much capital relative to their tolerance for loss. Position sizing is not an afterthought. It is the silent multiplier of discipline, the framework that turns waiting, observation, and confirmation into actionable edge. Too many amateurs believe that the bigger the position, the bigger the reward. They fail to see that size magnifies not only potential profits, but also potential errors, stress, and emotional reactivity. Livermore's genius was not predicting every move. It was engineering conditions in which mistakes were survivable and winning trades could be maximized. The principle is deceptively simple. Determine your maximum acceptable loss first, then size your position accordingly. If your stop loss is 50 cents per share and you are willing to risk $500 on a trade, then you buy 1,000 shares. That is it. The math is simple, but the discipline required is enormous. Many amateurs invert this process. They choose a position size first, hoping to maximize potential gains, and then panic at the first minor pullback, reducing rationality and often wiping out significant portions of capital. This misalignment of risk and size is the single most common reason novice traders fail, even when their technical skills are adequate. Professionals, by contrast, structure their trades around calculated risk. Every entry has a defined ceiling of loss, allowing the mind to remain calm, the hands steady, and the decisions rational. Consider a concrete scenario. Livermore identifies a breakout that has passed all confirmation signals. The tape shows absorption, volume aligns with momentum, and the stock is decisively testing a pivotal point. Instead of committing the full capital he might have allowed himself under his system, he sizes small, perhaps only 10% of what the system could accommodate. The trade initially retraces, testing patience. Because he has limited exposure, he does not panic. Stress is minimized, judgment remains intact, and when the breakout resumes, he participates fully, capturing the upside without compromising emotional control. Compare this to the amateur who jumps in with full allocation. Even a minor retracement triggers anxiety, impulsive exits, and sometimes catastrophic losses. Position sizing, therefore, is not just about capital allocation. It is the psychological scaffolding that permits disciplined execution under stress. The protocol is unambiguous. First determine risk, then decide position size. Never reverse the order. This should be combined with all prior layers: the 5-minute check, the 3 confirmation signals, and psychological control. Risk-first sizing ensures that every trade is survivable. Every pullback can be observed calmly, every unexpected movement interpreted rationally. This is the intersection where technical edge meets mental fortitude. It is also where amateurs consistently fail, entering trades with oversized positions and allowing fear or greed to dictate exits. Professionals understand that every small, disciplined trade reinforces the system. Every oversized, impulsive trade undermines it. Maxim: the size of your position determines the size of your patience. The larger the stake, the less room there is for measured observation. Large positions force emotion-driven exits. Small positions allow calm, rational engagement with the market. By managing size correctly, a trader can wait for confirmation, observe the tape, measure volume, respect pivotal points, and enter with conviction. This interplay between psychology and position sizing forms a nested loop. Proper sizing reinforces patience. Improper sizing destroys it. Size is leverage over your emotions, the stabilizer that ensures that even when the market tests your nerve, your decisions remain aligned with probability, not impulse. Let's dig deeper into the psychology. Traders often confuse size with confidence. They believe that buying more shares means they are more committed to the trade, or that it demonstrates certainty. In reality, oversized positions amplify fear, greed, and indecision. A minor pullback can feel catastrophic, triggering early exits, second-guessing, and emotional distress. Conversely, sizing small allows the mind to focus on observation and execution rather than survival. This is why professionals often look small, even when their conviction is high. The position is not a statement of confidence. It is a tool to ensure that rational judgment is maintained, even when the market is volatile. The relationship between position sizing and confirmations is also critical. Even if all 3 signals, the 5-minute check, volume, tape, and pivot point, align perfectly, improper size can turn an otherwise high-probability trade into a psychological trap. If the trade is large enough to threaten the trader's comfort, emotion will override evidence. Fear and greed enter the picture, and professional discipline erodes. The system fails not because the technical edge was wrong, but because the psychological framework could not sustain it. Livermore understood this intimately. Trading is not merely about identifying opportunity. It is about creating conditions in which probability can work in your favor without compromising. Mental equilibrium. Consider another practical example. A stock breaks out convincingly at 10 a.m. after passing the 5-minute check and all 3 confirmations. The amateur buys aggressively, allocating far more capital than risk tolerance allows. The stock pulls back by $1, a retracement well within normal market behavior, but the amateur panics and exits early, cutting a potential gain in half or worse. The professional, sizing appropriately, feels no psychological pressure. The pullback is observed, interpreted, and ultimately ignored if it does not violate risk parameters. When the move resumes, the professional is fully engaged, capturing upside without fear. This discipline converts high-probability setups into consistently profitable trades, while indiscipline converts even the best setups into losses. Nested loops again come into play. Position sizing reinforces psychological patience, which in turn allows confirmation signals to be trusted. which in turn validates waiting. Each layer of discipline supports the next. When properly executed, these loops create a system where risk is controlled, emotion is managed, and the trader can act decisively without overreaction. Oversized positions break this loop. They magnify every twitch of the tape into a crisis, every minor pullback into panic, and every hesitation into self-doubt. Professionals engineer trades to avoid this trap. Amateurs stumble into it repeatedly. Another critical principle: risk should be calculated in absolute dollar terms, relative to total capital. A $500 risk on a $10,000 account is manageable. A $5,000 risk on the same account is not. Professionals treat risk as a fixed, measurable quantity, not a variable to be adjusted based on enthusiasm. This is another edge. Consistent, disciplined risk management prevents emotional overreach and ensures that even a series of losing trades does not compromise the account. The math of risk-first sizing compounds over time, turning probability into long-term survival. It is important to note that this discipline also sets the stage for pyramiding. Once a position proves successful and favorable conditions continue, the professional may add incrementally, but each addition respects the same rigorous sizing and risk protocols. Amateurs, in contrast, tend to add too aggressively, doubling or tripling positions after initial gains and exposing themselves to amplified losses. Professional pyramiding is about controlled compounding, not reckless escalation. Position sizing is the gatekeeper that enables this. Without it, pyramiding becomes gambling. With it, it becomes a structured method of compounding probability. Finally, consider the larger philosophical lesson. Trading is not about predicting perfectly. It is about surviving long enough to capitalize on real opportunities. Position sizing ensures survival. Small, disciplined entries allow rational observation and structured response to market movement. Oversized positions force reaction, panic, and emotional distortion. The maxim "size determines patience" is not abstract, it is actionable. Proper sizing reinforces every other principle we have discussed: the 5-minute check, confirmation signals, psychological control, and waiting. It creates the conditions under which probability works in your favor. By internalizing this discipline, the trader prepares not only for isolated trades but for an entire trading career. Each high-probability entry, sized correctly, executed patiently, and confirmed with evidence, becomes a building block of long-term success. Improper sizing, conversely, ensures that even the best trades are compromised by human emotion. The professional understands this, the amateur ignores it, and the market rewards the former while punishing the latter. In conclusion, the lesson of position sizing is twofold. First, always determine risk before deciding position size. Second, integrate sizing with the 5-minute check, with a confirmation signals, and psychological discipline. Together, these create a resilient trading framework where errors are survivable, winners are maximized, and decision-making remains rational under pressure. This chapter transitions naturally to pyramiding, the process of adding to winning positions in a controlled manner. Once initial trades are managed correctly with proper size, incremental compounding can occur safely, following the same principles of evidence, patience, and risk management. Mastering position sizing is essential before attempting to pyramid. Without it, compounding becomes reckless rather than strategic, and the probability of ruin increases dramatically. Pyramiding is where most traders fail. The concept seems deceptively simple: add to winners and let profits compound. Yet, in practice, it is one of the most treacherous aspects of trading. Many amateurs believe that a winning position is an invitation to immediately scale up. They double or triple their initial allocation at the first sign of profit, blinded by greed and the illusion of control. The result? What began as a high-probability trade becomes a margin call, a panic exit, or a significant drawdown. Professionals, by contrast, understand that pyramiding is an art, not a reflex. Jesse Livermore didn't add blindly. He waited for the next confirmation. He treated each addition as a new trade, subject to the same rigorous checks that governed the original entry. Pyramiding, when done correctly, is a controlled method of compounding patience, not emotion. Imagine the scenario in vivid detail. Your initial trade has cleared the 5-minute check. Volume, tape, and pivotal points all align. The stock runs $2 in your favor. The amateur answer is immediate. Double down. Don't miss out. The professional answer is radically different. Wait. Watch the next confirmation candle. Observe the tape for absorption. Wise. Ensure volume continues to validate momentum. This moment of restraint is critical. Adding prematurely, without confirmation, converts a winning trade into a precarious one. Livermore knew that patience at this stage was even more valuable than courage. The market tests greed relentlessly. Those who scale impulsively are often the first to be punished. Those who scale methodically are the ones who compound their edge over time. The protocol for pyramiding is straightforward but requires discipline. Add only when your position meets all prior rules: volume alignment, tape behavior, and pivotal point verification. Each incremental addition should never risk more than 20 to 30% of your original allocation. This is critical. Large increments amplify emotional pressure, undermining patience and rational decision-making. Small, calculated additions allow the trader to maintain mental clarity, observe ongoing market behavior, and adjust without fear. Patience compounds gains. Greed compounds losses. Livermore's genius was in engineering a system in which each trade's risk was known, controlled, and psychologically manageable. The pyramid was built step by step, each layer verified, each position disciplined. Consider a historical illustration. In 1907, Livermore identified a railroad stock with a confirmed breakout. The initial trade had passed the 5-minute check and all 3 confirmation signals. Rather than immediately committing additional capital, he waited for the stock to retest its pivot point. Only after the test proved successful did he add incrementally. This process repeated, with each layer of the pyramid verified against volume, tape, and pivotal behavior. By the end of the sequence, Livermore's position was tenfold stronger than the initial allocation, yet every increment had been controlled and psychologically manageable. An amateur, in contrast, would have added aggressively at the first move, often triggering margin calls or being forced out during minor pullbacks. The lesson is clear. Scaling must respect the same disciplined framework that governs initial entries. Maxim: pyramiding is the art of compounding patience, not emotion. It is the disciplined amplification of an already high probability setup, not a reckless escalation based on enthusiasm. Professionals recognize that every new addition is a trade in itself. The market does not reward audacity divorced from discipline. It rewards structured, evidence-based scaling. By maintaining control, observing confirmations, and sizing carefully, the trader turns a single high-probability trade into a compounding machine for profit. Greed, impatience, and impulsiveness, by contrast, guarantee that even the best trades are eventually punished. Nested loops emerge at this stage. Notice how the 5-minute check, 3 confirmation signals, psychological control, and proper sizing all feed directly into pyramiding. Each principle reinforces the next. Patience allows you to wait for confirmation. Confirmation guides rational scaling. Proper sizing ensures emotional stability. Psychological control maintains composure in the face of temptation. The pyramid is not merely a technique. It is the culmination of every prior lesson applied in real time. Professionals use this system to build positions gradually, safely, and methodically. Amateurs, lacking these structures, react impulsively, compounding errors rather than profits. It's essential to highlight the emotional component. Every addition to a winning trade triggers internal pressure. Fear of missing out competes with fear of loss. Greed whispers that larger stakes mean larger rewards. The professional counters these impulses with protocol. Each addition is subjected to the same rigorous checks as the original trade. Volume must validate the move. Tape must show absorption. Pivot points must be confirmed. Risk is predefined. Emotional impulses are subordinated to process. The result is compounding without chaos, growth without recklessness. Consider a practical example. A stock surges $3 after the initial trade. The amateur, seeing momentum, adds the entire remaining allocation, effectively doubling exposure. 5 minutes later, the stock retraces slightly, a natural pullback. Panic sets in. The trade is closed prematurely, leaving significant profits on the table and teaching the mind to fear minor retracements. The professional, by contrast, adds a small, controlled increment after verification, maintaining a manageable risk profile. When the stock continues its run, the professional participates in the upside without emotional compromise. Small, methodical pyramiding transforms high-probability setups into exponential gains, while premature scaling converts opportunity into volatility-induced loss. Position sizing continues to interact with pyramiding in nested loops. Without proper sizing, the pyramid is unstable. Each addition magnifies both profit and potential error. Small, disciplined increments maintain equilibrium, reinforcing patience, enabling observation, and allowing the system to operate predictably. Improper sizing destroys the loop, converting even confirmed trades into psychological traps. Livermore's brilliance lay in engineering conditions where mistakes were survivable and incremental gains were compounding safely. This is the essence of professional pyramiding: edge plus discipline plus patience. Historical context reinforces the lesson. Livermore's pyramiding strategy allowed him to turn small, verified trades into positions large enough to move markets, while never exposing himself to catastrophic risk. By adding only when confirmations aligned and increments were controlled, he created a feedback loop. Each successful step reinforced confidence. Each step violated by amateurs' impatience led to losses. The pyramid, therefore, is both tactical and psychological. It is a measure of discipline in action, a manifestation of every prior principle executed at scale. Maxim reinforced. Each step of pyramiding is a mini-trade, evaluated independently. Confirmation signals, size, discipline, and psychological control are non-negotiable for each increment. Greed is the enemy. Patience is the ally. Professionals understand that compounding occurs not by reckless acceleration, but by measured application of proven rules. This mindset turns the market into a compounding engine for profits, rather than a minefield of impulsive loss. The nested loops converge. The 5-minute check prevents false entries. Confirmation signals validate momentum. Psychological control mitigates fear and greed. Proper sizing stabilizes the position, and pyramiding compounds the edge without amplifying risk. Each principle reinforces the others in a self-sustaining system. Professionals execute methodically, amateurs react emotionally. The difference is not luck. It is process, protocol, and discipline. Finally, this chapter closes the loop on the core lessons of the 5-minute check system. By integrating initial verification, confirmation, mental discipline, sizing, and pyramiding, the trader creates a comprehensive framework for sustainable profitability. The 5-minute check is more than a tactical tool. It is a mindset. Every layer, weighting, confirming, sizing, psychological control, and scaling forms a cohesive architecture. When applied rigorously, the market ceases to be a chaotic adversary and becomes a compounding machine for those with discipline. Cut losses fast, size small, wait, and own your process. This methodology is transferable across markets, time frames, and instruments, forming the foundation for advanced edge, including reading tape in volatile conditions, which will be explored in subsequent lessons. By mastering pyramiding in this disciplined manner, traders learn the ultimate lesson of professional trading. Leverage is derived from process, not luck. Compounding is achieved through patience, verification, and controlled scaling. Greed and impatience remain constant threats, but when every step is governed by rules, they are neutralized. Professionals systematically exploit probability. Amateurs are systematically exploited by it. The art of pyramiding, when executed within this system, transforms small, high-probability trades into positions capable of generating substantial, sustained gains. The closing maxim encapsulates the philosophy. Patience verified, size controlled, scale disciplined compounding becomes inevitable. The nested loops of waiting, confirmation, psychological control, and position sizing are the foundation of sustainable trading. The pyramid is simply the manifestation of these principles in motion. Applied consistently, this approach allows the trader to harness market momentum, magnify edge, and maintain composure under pressure. Applied inconsistently, it guarantees ruin. This is the defining contrast between professional and amateur traders, and the ultimate payoff of disciplined process, compounding edge built on patience, verification, and strategic scaling.